Another episode, and today we're going to talk about anything you guys want to talk about. We'll do a live Q&A session. You can bring your questions. You can say whatever you got to say about real estate, stocks, personal finance, any questions that you have burning, in the back subconscious of your brain to release, put it in the chat, because I have no topic for today. I didn't prepare anything. What has happened in the last week? Well, let's talk about the stock market first and just the market in general. FOMC meeting about a week ago now. We had the Fed basically say, hey, we're going to lower rates next year, which is like no surprise. Every economist in the world is expecting like 6 rate cuts next year, but they say they're going to get 3 for sure. And what else has happened? Well, the market has gone up now for the biggest rally that I've ever seen in my stock investing career on the NASDAQ. So the NASDAQ on October 26th was 300 on the QQQ, was 342 on the QQQ ETF that tracks the NASDAQ. It was a 342 point reading. From October 26th through into November, it rallied to create new year-to-date highs in the 380s, and it kept going into the 390s, into 400. And today, it topped out over $410. That is a 70-point increase from 340 to over 410. It was the largest consecutive rally from October 27th, let's call it, almost November 1st, to, I guess we're like a little past almost 2/3 through December. So in that 10-week period, we never had any substantive down days consecutively. So we had update, one small down day. All of that retraced the next day. Update, up, green, week after week after week after week. 19% on the index we rallied in a under 2-month period. It was an insane rally. We were looking at 54% growth on the NASDAQ on the year to date. It was an insane rally that really has only come close, I think, in the .com bubble. We're calling it the AI bubble, and hype is at a maximum. So it was a crazy time to be watching stocks, a crazy time for me to be short the market. And part of what I want to talk about today is, something that I've talked about ad nauseum on this channel, but diversification. And why it's important, I think, to have many different asset classes, because if you just have one, you're going to be screwed when it comes time for, when one asset class tanks. So if you're all crypto, then you're destroyed when it comes time for a crypto recession. If you're all in on stocks, you feel it acutely when we go through a recession like we went through, last year, let's call it. And I think we should really still be technically in a recession. The downside is that we know the market is manipulated, right? And the Fed really controls the market. And what we know is that there's never been a down year in an election year ever. And that's not a coincidence. There's a reason. And by the way, next year is an election year. So there won't be, well, if it is, it'll be the first time in history that there's ever been a recession in an election year. They will find a way to curb that, either through printing and stimulation. They've done it through the jobs report. They've been able to print jobs effectively, stimulating the areas of the economy, right? Where, where honestly, there really hasn't been a lot of great job growth. There's been a lot of deceleration in the job market, but in areas like construction that are government funded and public sector, there have been a lot of great contracts that have created a lot of wealth in those areas. And that's just government spending that some of us then pay. So that's a taxpayer future expense. That is, unfortunately, the Democrats' main platform. They love to rack up the bills for the future generations to pay. I don't know where it's going to come from. Probably from pillaging some other country in war or something like that. That'd be a great way for that's the Democrats' favorite way. They drop more bombs than any other party by a long shot. But trying not to let my political bias show. David says, hello from Canada's fastest growing province in the third quarter. You guessed it, Alberta. What's interesting? A friend of mine shared a post about, I think it was out east in, I want to say it was in like New Brunswick, maybe Moncton. But there was an area that's actually the only city that has had no pullback at all and been green the entire time, which is, again, mostly because the average house there is like $200,000 in that part of Canada. So, of course, they're not really feeling the effects of rates because, again, $200,000 and the income is like 40 or 50,000. It's reasonable. When in Ontario here, when you have average house $1.5 million and the average income still 75,000, you're like, how does anyone afford? Oh, right, they don't, right? They get gifts from their parents. They get, it's a two families coming together to share a house, very common, or there are foreigners that come in and or they've been in the market already and they've continued to upsize, and majority of their net worth is trapped in a house if they live in Toronto or Vancouver. So those markets, again, make very little sense. Yeah, I saw a comment there about the NASDAQ. So the NASDAQ around 3 o'clock today, 2:30, 3 o'clock. I'm not sure the exact time. I remember checking my phone around 3 o'clock. It collapsed almost 2% today. It was up, I think, like 1/3%, almost 0.5% as it actually found a new top today and then bounced off that 410 new top. It was a new all-time, I think a new all-time high maybe. We crushed year-to-date highs in the 380s, but I think we hit an all-time high today on the QQQ. I don't think QQ's ever been in the above 410. I think in 2021 it hit like 405, 406. So QQQ is definitely, full of bullish energy. I'm seeing, and I like to, it just as an interesting aside, like I don't try to believe that I'm smarter than the market. Clearly I'm not. Clearly I'm wrong on that, right? And clearly most people are when it comes. That's why I like real estate so much, is because you don't have to be smarter than the market. Because the market's so fragmented and so easily arbitraged, there isn't really a market for real estate. I can go buy, Sally John's house for $90,000 and it will appraise at 200. I can never go buy Sally's shares in Apple at $100 a share when they're trading at 190. There's a perfect market for it. There isn't a perfect market for real estate. I want to share with you guys a deal that we did. It's a fantastic deal in Florida, and we're walking in on a foreclosure. Imagine. So in the stock market, if you lever up and you put a mortgage against your stock portfolio and then you get a margin call on that, it's callable debt, first off. Real estate debt is usually not callable, so they can't actually take the property back unless you default on payments. In the stock world, they'll just liquidate you whether you make the payments or not because the market's instantly liquid, right? So anyway, I want to tell you about a deal that I did that explains the value of real estate. And we're walking into this deal for less than 4.5% to 5% down, seller financed at 3% second mortgage and a 7% first, averaging at 5% cost of debt. But at like 95, 96% loan to value, that's an amazing deal. You make a 10% return at 5% down the overall asset, and you're looking at like a 200% yield, right, on that property over a 2-year period. So easy to do with very high leverage. That's where real estate can be really sexy, because you can buy assets that can self-sustain. Imagine buying, it's like borrowing in a fixed debt against a dividend stock that pays 7%, but borrowing at 3% against that stock, but it's non-callable. So if we go through a recession, they can't sell your shares. They can't sell the real estate from with under you as long as you can make the payments. So real estate is really just like a business in a lot of ways. So that's what I like about real estate. It's, again, for me, like lending is another area where I have a huge competitive advantage. I know lots of people who want me to fund their flips and fund their deals, and they'll pay 10, 12, 14, 16% and let me have 70% loan to value, which is essentially risk-free. If I'm in first secured position on a flip that's worth 50% of my mortgage against it, on day one they buy it at a good enough discount, it's possible that if I fund 75% of the purchase price, that's 50% of what it's worth in the open market. And here in Ontario, I'm a realtor. I can go and liquidate that property with very little cost. So for me, it's like, it's a no-brainer to be lending against those assets at such great loan to value. I can get almost a risk-free 12% return, which like the bond market's paying between 4 and 5% for risk-free right now. Again, yields have fallen a ton in the last 6 weeks, as has been evidenced by it. What's interesting too, if you look historically, as rates come down, real estate prices do go up. But the stock market actually initially, when you start to cut rates, typically is aligned to typically the reason they're cutting rates is because we're in a recession, right? But what you normally see is that stocks don't do so well. So it's interesting to see how next year is going to play out. It could make sense we have a little bit of a pullback here in the short term because we've just been so frothy for so long. But at the same time, who wants to harvest their gains? If you own NASDAQ shares, you own Google, you own Meta, this is basically Facebook. A lot of these tech companies are up 50, 100%. Nvidia's up a couple 100%. A lot of these people have doubled, tripled their money. A lot of the rich have gotten really, really rich this year. And if they sell now in December, they're going to have to pay tax on that in the next 3 months. But if they sell it in January, they get a year and a half to pay tax the following April of 2025. So most people, even if they're up, won't cut. So that's just something to kind of think about there. Oh, someone sent a message says, your audio is cutting in and out a lot. I wish I had a better answer for that. Hopefully it's just, your computer, and hopefully it's not the entire internet here. I don't know. It says I'm connected to the internet. Let's just check. Yeah, I still look like I'm connected. If everyone else is having this issue too, let me know, and I'll do what I can to try to resolve that. We have new fiber internet here, but I've noticed it's been worse. I think the challenge is that the way they ran the fiber in my house, they ran it almost next to electrical wires like that, and I think the hydro is messing with the fiber, but that could be all in my head. I read an article that does affect internet data packages transferring. John says, evening, Mike. Hello. Going full Farrah Fawcett without goatee or Fabio? Thanks for the live feed. Oh yeah, I last week I got back from Florida, and I was in Florida. I don't know if you guys remembered, but I left for Florida. I did the stream just before I left, so that's how. Or did I do the stream? No, I did the stream while I was in Florida. Yeah, you guys saw the stream last Wednesday in Florida. But yeah, we got back from Florida, and I was like, I need a fresh start. My face was, getting gangly, and I was like, I'm just gonna shave it off. So I think I shaved on, I don't know, Sunday or something. It's been great. I have had a beard on for over a year, and I thought, well, it's time for something new. I'm gonna get a haircut too. It's getting crazy and out of control, but again, there's no real burning need to do it. I could just take my time with it. Dan says, hey, Mike, got a question. Basically, I have a deal seller financed, and my lawyer tells me to get a corp since this will stop me from buying more properties in the future. I'm not understanding what the question is. So when you buy inside of a corp, does that ensure that you have, it depends. Really, the question is the seller going to require a personal guarantee? And if they require a personal guarantee, will they register it on your credit bureau? And that's up to the lawyer that they have. You could buy in a corp with a personal guarantee, and it will still show up on your credit report. And anything inside your corporation, they will likely make you still declare as a debt. But yeah, I suppose inside of a corporation does a few things. One, it could, if you didn't pierce the corporate veil, it could leave you open to protection against personal lawsuit potentially. And so there's that. It could be beneficial. It could be that if you use the corp and they don't make you personally guarantee and register on your credit bureau, that again, that would shelter you from personal qualification later. I agree. I think in general, putting it inside of a corp is a good idea. I think in most cases, it makes sense to do that. For a lot of my deals now, put them inside of corps or LLCs. It is a better structure. Admittedly, it has its advantages. Now, there are some certain reasons why you might want to put it in your personal name. That would be like, you get better financing. This is seller finance. So yeah, I think you're probably better off to put it inside of a corp just without knowing the specifics of your situation. Probably makes sense to spend a couple of grand to set one up and a couple of grand to maintain one in terms of an extra additional filing on an annual tax basis. And yeah, I think it's probably worth it in that case, again, for your financing. No audio issues on your end. Perfect. Good to hear. Glad that not everyone's having the issues right now. Bum, bum. Do you need a corp or can you buy more properties using personal name? So again, you could buy properties in your personal name. It will affect your debt service if you buy in your personal name for sure. If you put it inside of a corp, it may not, or it may. Depends how they register the product. So I have done deals inside of a corporation where the lender would then register to my credit bureau. And even though it was inside of a corporation, I had to then declare it to all of my personal applications. Inside of a corporation should give you some layer of protection, and you may not have to disclose it. When they ask your personal financial statement, they aren't asking about what's going on inside of your corporation. And so you could be truthful in your declaration of all assets and liabilities in your personal name, leaving out what's going on inside of your corporation. So yeah, I would say for seller financing, in most cases, it does make sense to set up a corporation, even though there's extra costs to do so. Unless the deal is tiny. Like if it's a $100,000 deal or $200,000 property, it probably doesn't make sense. But if it's a bigger deal, it generally makes sense. The costs are prohibitive and just kind of not really worth it if it's a smaller deal. Damien says, hey, Mike, how do you go about finding tenants? Do you hire someone to advertise your units? So the way I used to do it is I would put up ads on Marketplace and Kijiji, and I used to go and screen each person myself, and then I would get a virtual tour of the property made, and I would have photos, and then the people who I liked, I would send them a questionnaire, and if they responded to the questionnaire, I would send them the 3D tour and the video of the unit at a private YouTube link. And if they've seen the whole apartment and they've watched the whole video, I would ask them, have you seen the whole apartment? What do you think? And then we get on the phone. And most of the time, I could rent it simply from a 3D floor plan and a video and have to do no physical in-person showing until the time of lease signing. Any good, serious tenant doesn't want to waste their time anyway once they've seen a 3D tour and a video of the place. Sometimes they want to meet you for lease signing at the property, which is fair. They get to see the place in person. What you don't want to do is line up a bunch of showings at random times. And if you're going to do it, line up 4 or 5 showings in a 30 to 45 minute period back to back, because some of them aren't going to show up. Never line up one showing and go to the property. There's lots of property management. I could write a whole course on property management, and that's where I started, was in the trenches. It is shit work. Good property managers make $25 an hour. There are bad property managers who make more per hour. And that's because they neglect their portfolio. They don't spend the proper time running their business properly, and they're neglecting your property in some way, placing bad tenants, not managing them properly. So to make good money at property management, you have to either have huge scale, which means you have a huge number of units, and then you have a lot of staff. That can make sense. Economies of scale can make property management profitable. Or you have to neglect the properties in some way. If it's a 1, 2, or 3-man operation, it is a very low dollars per hour work. Property management, it's like $25 an hour work. I think that's horrible. I bill out at $1,000 an hour minimum. Like, when I got a coaching call with someone, I can make $1,000. I go and work on a deal, I make $1,000 to $10,000 an hour. So I don't like to do anything that's less than $1,000 an hour with my time. I'm forcing myself now to not pick up my tools around my house. I outsource that. I would get a contractor here and I pay them $300 a day and have them do things around the house. Because again, I'm better off spending that time doing income, revenue generating activity of any sort that is worth more than $1,000 an hour. So I'm trying to focus my time. Even $1,000 an hour is shitty. Like $1,000 an hour, an average person works 2,500 hours a year. Like even $1,000 an hour isn't that good at 2,000 hours a year. Like it's not that great. That's like $2 million. So like really, like when you become a pro, you want to be doing just activities that scale. You don't want to be trading your time for money. But I would say if I had to trade time for money, it would definitely not be doing property management. So yes, to answer your question, I do outsource. It's a great place to start. If you're just getting started, your time isn't valuable. And people think that's rude or condescending, but like it's a fact. If you're just getting started out and you have 1 or 2 or 3 or 4 or 5 properties, if you work somewhere making 50 grand a year, your time isn't worth jack shit. You're worth $20 an hour, $25 an hour. So manage your own fucking property. I'm sorry to say, but a lot of people are entitled. And they aren't worth $1,000 an hour, but they act like they are, and they outsource everything in their life, from Uber Eats to getting their laundry done by someone, to having a cleaner come in, to et cetera, so forth, outsourcing everything in their life. And there is some value to outsourcing. And I think it's important to do that if your time is valuable. Most people outsource and aren't valuable. Anyway, I digress. Lately, my time has been a lot less valuable with how I've spent it trading stocks. That's been the stupidest thing of my entire life that I've ever done, was thinking that I was smarter than the market. And I've said ad nauseum, I wrote articles on my LinkedIn that I since deleted, on my old website, 25andfree.com. When I retired when I was 24, I wrote articles about the smartness of not trying to beat the market, about how great it was to dollar cost average into the index, not look at it, because again, the human is a horrible dictator. There are no, what am I trying to say, dictator of the future, predictor of the future. There are like statistically no one who can predict the future with any degree of accuracy when it comes to stock prices. That's why technical analysis, there's 5 ways to, I guess, value stocks and determine, whether something's undervalued or overvalued. One of the 5 ways is technical analysis, TNA, where they're charts. It's the shittiest way and the least reliable way to determine pricing. And there are certain people who trade just on charts alone, right? Value investing is another great one. Horrible to predict where the future is short term. It's actually very, very accurate in the long term, right? Where you determine the enterprise value and the asset value of a company, and you look at the net asset value, you can compare whether there's real value there. You can contrast, and basically you would present value all future cash flows to simplify it, and use that value to determine what the business is worth at a certain discount, depending on where you think inflation is going to be and where you think rates are going to be and what your internal hurdle rates are going to need to be. When you're analyzing these companies, you can determine a future value for that company. And then what can happen is you can say, hey, the value is here, and it's currently trading at half of where I think the value is. Okay, there's some value here. We can acquire these shares, and we've acquired these assets that the shares own, net of all debts. And you can say, hey, there's real intrinsic value here, and someday the market will realize this value if you can find a good enough catalyst for said thing to happen. And value investors, I think, have the closest to beating the market when it comes to a strategy. But technical analysis is one of the shittiest forms of beating the market. But what we know generally is you want to diversify because there's safety in diversity. And at least I've already shared this at length on this channel, but I have no business trading stock. I don't know why I do it. It's the gambler in me, maybe. At first, it was a bit of fun. At first, it was a bit of like, I would share it with friends what we were doing. We would share on different stocks we were shorting or different stocks we were longing. And there's fun in it. This year has zapped the fun out of it for me, such to the point where I open up the Interactive Brokers app and I get PTSD looking at my positions. And all I can think about is how badly I fucked up shorting this year as it rallied 54% and I shorted that and lost half my portfolio. I lost well over $1 million. And it's like, that's not even a big deal. Like, it really hasn't. I was thinking about it the other day. I'm like, that doesn't even change my life in any material way. Like, nothing changes physically for me. I go on the same trips, live in the same house, drive the same car. We eat the same. Nothing changes. I'm still financially independent. I'm still retired. It's all just fucking play money. But I worked so hard for that money. I did so many flips, probably 40 or 50 flips to make the money that I lost trading. And it's like, in a lot of ways, I'm thankful for going through this, because if I had made these mistakes with 200 million or 300 million, and I allocated a quarter of my net worth into a stock trading account, let's just say that I, did that, it would be a much bigger loss. And thankfully, I know now that I don't want that allocation in my life. I'd rather go hard on real estate and lending and businesses and things that I can control than have that diversity. And I'm okay with the fact that there's risk in having less asset class, having less assets in the bucket. But I'm comforted by the fact that it's very hard for me to underperform the market with the edge that I have. And I have no edge in the stock market. None of you have an edge in the stock market. Maybe in the short term, you think that you have an edge in the stock market. Maybe you bought some course, or you developed some algorithm, or bought some computer bot program. The data shows that the best guys on Wall Street, the best hedge funds with the smartest and brightest minds, most of them, net of fees over a 25-year period, do not beat the market. And if they do, did it justify all of the time that they spent? And if you divide out all of the energy and effort, I don't know that it necessarily does. Net of fees beat the do nothing approach, which is just like buy the index and don't look at it ever. Buy the S&P 500, buy some emerging market stuff. Don't be like me and buy Russia. I fucking bought the Russian index. I put like 140 grand. I diversified into, at a time I diversified into a bunch of countries. And I fucking saw Russia dropping like crazy. And I didn't know that the US would ban the ownership of Russian equities and froze the ETFs holding these Russian companies and forced them to zero. They grabbed all these Russian companies and just squeezed them by the balls, and they put it inside. Basically, the ETFs are forced to sit there and charge you a fee, and they can't do anything. They can't liquidate the positions. It's still frozen. It's now been almost 2 years. I think it has been now. And it's still frozen. Maybe a year and a half. I don't know. It was 2022, February, maybe March, sometime in that. I don't know when. A year and a half ago, let's call it. Coming up on 2 years, sometime in 2024, spring, I want to say. And I lost my train of thought, but just shitty how things can be manipulated and things can be out of your control. And I don't like that feeling. I like being in control. And with real estate, you hold and you win. I like that about it. And if you lean in harder, you can guaranteed win. I like that about it. The passiveness of stocks doesn't exist for me. Like, when I'm lending someone money against a house, I don't lose any sleep at night. If I've done my research up front, I do all the research up front, I secure a mortgage on the property, I sleep fine at night. I no longer do any promissory lending. I no longer, it's not true. It's less than $25,000. I do some micro lending. Occasionally with certain contractors, I'll take title of their car and I'll lend them money. It's very rare that I do any large amounts, but I definitely don't do any third mortgages, any unsecured lending anymore. I've been down that road. I've been burned. I even avoid second mortgages for the most part. And I definitely don't fund 100% of the deal anymore. Those are rookie mistakes, trying to chase yield. Don't do that. If you do it properly, it's very, very passive. And I like that about lending, where you can get like a 12% return and do nothing. And I was sitting there the other night. It's a blessing in a lot of ways what I've gone through this year, because it's like, why? Why would I take that kind of risk? As an example, shorting the market with margin. Why would I do that? Like, let's just say I made an extra $1 million. Does it change my life in any way? Like, no. Like, what was I doing? Chasing that yield. It's like, trying to get back. It was ego, I think, in a lot of ways, of wanting to beat the market. And it was hard to admit that market share went down. It didn't. It went up 55%. It maybe should have went up 10% this year. I think that a 10% recovery, it made sense. It's a lot like the dot-com bubble, where they think the efficiencies of AI software are going to be realized and larger than they actually are. And though AI, just like the dot-com bubble, will transform business and industry, it won't happen overnight. It won't be in 1 quarter or 2 quarters. It's going to take a long time. And there's a lot of speculation and hype, and people are paying large premiums based on actual earnings. So they're factoring in a lot of growth, and they're paying for that set growth. The problem is competitors come in and targets aren't reached, and things that they thought might happen don't, and shit happens in the real world. And when you pay too much for what can happen in the future, it's not a good idea. So with real estate, I like the fact that, well, look at the Toronto bubble. Like in Toronto right now, we have an insane real estate bubble. And it's like, that makes no sense, right? But people keep buying. They're buying properties at a 4 cap rate, which, like, if you do the math on that, you need like decades to make your money back purely from cash flows. They're investing as a speculator. They're hoping on future price to be larger in the future. That's not how I buy real estate. That's not the right way to do it. You want to buy real estate that produces solid cash flow that sustains itself. Developers buy land and they go cash burn, cash burn, cash burn. They bribe the city eventually. 10 years later, they get approval, and they get a huge windfall, appreciation, and huge lift. That's not the kind of investing that I do for the most part. Most of what I do is focused on solid, consistent cash flow, finding ways to reduce expenses, increase income, and then sell that building for a large profit. I do occasionally flip, but again, not my focus. So it's been good. It's been good. Going through this has been very depressing through stages of it, but it's also been very enlightening. And at least I have $1.5 million tax carry forward loss that I can go make $1.5 million tax free. It's an advantage because I can get back to where I was faster. Bum, bum, bum. Wait, next question. Okay, it says, I guess, outsourcing property management, good idea. John says, what do you think is the most important key to scale a fix and flip business to $800,000 a year in net profit in Ontario? What do you think is you're thinking for the most important key? There's like one thing that would get you there. There's a few things that are really difficult about flipping. For one, I think one of the most challenging pieces of flipping for most people, I haven't had this problem, but the one I hear most often is deal flow. They have a hard time identifying really good opportunities and then consistently locking those up in an order that keeps their staff busy. Because you need your own personal staff. Because the second piece is you need to have a really good team of people. And they need to be only your people. You can't share your contracting staff with other flippers, because that's the hardest part, is having that resource of good quality contractors at reasonable prices. That's hard to do. Like, anyone can hire contractors at $60 an hour, $70 an hour, and do flips. No. You need to find the guys for $30 an hour who are as good as the $70 an hour guys, and then incentivize them, keep them with you, loyal to only you, taking no side work and focused on your flips so they get done fast, and you have a huge team that gets everything done. Your people. So the deal flow, obviously really important. The people and keeping those locked down, super, super important. And they're tied together, because if you fuck up the deal flow for even a month or two, and those guys are out of work for even 2 weeks, they'll leave you for someone else. So you got to keep them busy, which is a challenge in and of itself. I think the third thing that people struggle with is the money flow. With flips, what happens is this. You buy a property. Most people think that with flipping, it's like, oh, it's a great cash flow business. It's not. Most people will take on a bunch of flips and burn so much cash, and then shit won't sell when you want it to. We go through a down market like we just went through, and you're stuck for another 3 months holding that property, burning a high interest mortgage payment. Because again, if you put an A-lender mortgage on there, they're never going to lend you again if you start doing flips with bank funds. The A-lender bank funds are not designed for flipping. If you do that, it's a violation of their policy. One, they charge you a 3-month plus fees, 3 months of interest payments and penalties. And then if you keep doing that with them, they would burn you. So you never want to flip with A-lender money. You've got to use private lenders, guys like me, who are like designing products that are designed for alternative lending, designed for 3 months, 6-month products where you can break that mortgage, and we're okay with it. And we want that and keep doing that. The banks don't want that. They want to place a mortgage for 5 or 10 or 20 years and it be set. There's too many transaction costs for them. They don't charge any upfront fees. So the bank doesn't want that. Then anyway, but back to the flipping piece. The money piece is difficult. And a lot of these guys get in big flipping businesses and they don't have the cash flow reserves. They don't have you got to put aside $500,000 or $1 million. If you're doing $800,000 a year, you probably need $800,000 in float. I would say at least 1 times your profit margin in just a float that's there to handle your flipping business of your own capital. And then you need to also have the right lending products in place and the right connections to be able to continue that process. You need to have financing. And often that's just the alternative lender who's fine to back you up and you work a deal together. So flipping is a tough business in this kind of market. Now, I'm really bullish on flippers right now because we're going into, especially in Ontario, we're going into a really frothy spring. I think May is going to be insane. We might see, from where we are right now in prices to where we are in May, I think we might see a 15% rip up in my market locally. 15% is substantial, but that's what we're going to see, I think. We're going to get like 3 to 4% appreciation a month after month after month going into this summer. It's going to be so frothy. We're going to retest the lows probably December 2024 again. We're going to retrace some of that, but I don't think it's going to get as bad as it is right now, unless, of course, the Fed cuts too early, in which case we have running inflation and massive pain and economic recession. So it's between a rock and a hard place right now. It's looking like they might be able to land the plane just right by manipulating the numbers and massaging things and running a huge federal deficit up to make things look like we have a strong economy and inflation's coming down. We'll see. They could easily slip up, but it's looking really good. And I think the spring will be good no matter what. Given the current data that we have, the spring is going to be very strong. So I'm extremely bullish on real estate in the short term. But yeah, flipping is a tough business. A lot of flippers going belly up. A lot of them making negative or less than zero in this market. They say they're making money, but that's because they're trying to raise capital. A lot of these funds, a lot of these guys behind the covers, I've talked to a lot of accountants that do their books here in Ontario. Most of them are fucked. Straight up having a horrible year, losing so much money. If they've been in the business a long time, they have a lot of equity, personal net worth, then they can cover those losses. They're not going bankrupt, but they're feeling it nonetheless. I'm one of them. Like this year, I'm lucky. I'm going to make some money from real estate. But if you add in my stock losses, I'm going to lose money for this year. It's a shitty recession. Net worth goes down in recessions. It's lucky I have years and years and years of success, right? I've been hitting home runs since 2012. So I can fall back on my 2015, 2016, 2017, 2018, 2019, 2020, 2021, 2022 successes. And so if I have a couple bad years, no big deal. I have all that success behind me. But a lot of these guys just started flipping in 2020. And it's like they had a really good year in 2020, a really good year in 2021. 2022 was amazing too. And that started to be shitty towards the end of 2022. And 2023 has been a shit year. And so it's like those guys I'd be nervous about doing business with, making sure that you have extra protection in there. If you're a lender and if you're an investor in those funds, just be very careful, guys, through these times because they're being stress tested right now. And yeah, that's all I gotta say. Be careful, everyone. If you're a flipper, you'll get through this. It's a really good time to be a flipper now. If you're just getting into projects, now's a good time to get into them, I think, because we're gonna have a great spring sale. So the people that are loaded up on projects, they're trying to sell them now. That's not great. I have a bunch of properties still for sale. We sold a few, but I still have several more for sale. And I'm like, I might just hold these and just sell them in the spring. Like the cost of carrying versus selling now, I'm better off holding these projects until the spring than I am selling them right now, just because where the market is. And I think it's gonna be that much of a rip into the spring as rates fall that yeah, I'm actually thinking about just holding. And it sounds stupid, right? Like, if like 3-4 months of carry cost, but the exit price is going to be phenomenal, I think, in the spring. And just in general, from December to the spring, you tend to get a 10% variance in price, assuming the market's flat. So you get a 10% lift. This year, we're going to have 10% plus 5 or 10% more on top of that due to the rates falling and affordability coming back into perspective. Plus, you get a lot of people who are in asset classes like, tech stocks and crypto that's just rallied like 100%. And so they have all that money, but they don't want to harvest yet until January. So there'll be a lot of harvesting going on in January, because then they can have a year and a half to pay the tax bill on all those gains that they had. They're not going to harvest now in December and lock those gains in now because then they pay tax on it in April. That would be silly. Why would they do that? They wait till January and pay it in April 2025 when they file that 2024 return. So that's just basic, accounting 101. There'll be harvesting and rebalancing mostly done. The reason last December was so bad is because we had so many losses. People were harvesting in December, but typically December is very much a rally month, and January, February tends to be where you get a bit of a pullback. So I don't know. Again, no one can predict the market accurately. So there are anomalies that happen always, and the black swans and the white swan events wipe us out. In this case, a white swan event wiped out my short. Last year we had a black swan event that wiped out the longs. Shit happens. And yeah, that's why we have diversification. That's why small assets in many different places is much, much safer than having all your eggs in one basket. Hey, Mike, what are your goals for 2024? I try not to talk about my goals too much, but I have some ambitious goals on the finance and growth side and in building a business. Most of my goals for 2024 are based around personal growth. There are a lot of personal growth things that I'd like to do that I haven't done in my life. And I just turned 31. Like, cringe. I can't believe I'm 31 years old now. Oh, brutal. Had a lot of things I want to do. And so 2024 is going to be a year of doing a lot of cool things and setting up a lot of really cool things. A lot of people say, like, oh, this is going to be my year, but like 2024 is going to be my year. It's going to be sweet. I'm really excited for it. So yeah, I got a lot of really great goals, and I want to enjoy a lot of my success. I've had a lot of success over the years, and I want to start enjoying a little bit more of what I'm doing. So yeah, I'm not going to push myself to do a lot of producing and push myself to do a lot of enjoying, which is like hard for me because my natural resting state is like workaholic. Fred says, you left Florida. Some of us just arrived. We miss you here in Southeast Florida, Boca, down to Aventura, Miami, compared with East Coast as an investment. So am I talking about, Fred, just in general? I would say, when talking about Florida in general, I like the East Coast better than the West Coast. That's not to say the East Coast is better than the West Coast. I think that the East Coast is better fit for me. And one of the reasons for that is I want to set up a Bahamas reallocation. So I'm going to move to the Bahamas at some point because it's a tax-free destination where you can live 90 days a year and keep residency. And it's 60 miles from, say, West Palm Beach or, some of the eastern areas. So you can boat back and forth really quickly. You can fly in 18 minutes. It's like driving, across the city. I can fly between the Bahamas and with my own private plane if I wanted to. They have plane communities from Daytona Beach all the way down to Miami. And it's called a hangar house. And hangar houses have, attached to the garage, they have a place for your plane, and they have an airport built into the condo fee. So a lot of people just go back and forth. Like, I could live in the Bahamas, Monday to Thursday, and then be in Florida Thursday, or I could work in Florida, let's say, Monday to Thursday, and then go to the Bahamas on the weekend. If you get 90 days a year, you have residency. If you stay out of the US, 120 days is the maximum. You can be a non-resident, non-tax resident. So they won't tax your worldwide income. And then in Canada, you keep your Canadian passport, but if you stay out of Canada as a non-resident, you cut ties, you're only in Canada for, say, 4 or 5 months a year doing some business there, but you don't live there, pay no tax in Canada. You're a resident of the Bahamas. You can set up a structure where you can 1031 exchange. In the US, you can set up some really cool structures. So my long-term goal will be to retire to the Bahamas. It still is that reason that I want the East Coast, Florida, because of that triangle. I think that's a really great triangle from a proximity perspective. Bahamas comes, I guess, like Dubai came close to Bahamas, but Dubai's been nerfed recently. The tax has been made not as great. Also, Dubai's far, and you have to be there a lot. Whereas Bahamas is the one place you don't have to be there very often. You go to the Cayman Islands, you got to be there 6 days in a month, or 6 months and a day. So that's a big commitment. But 90 days spread out throughout the year, it's not a huge commitment to maintain residency. And so the Bahamas holds a number of reasons for being a tax haven. Right now, it's not a good fit because I had this $1.5 million loss that I can use. So I'm staying in Canada for a little while. It's delaying that move. And in some ways, I'm blessed for that because, my kids are just loving, they're loving Canada. They're loving, being around family here. They love going in the winters to where it's warm. They love being here in the summer at our cottage and on the lake here. Honestly, the beaches here on Lake Huron with the beautiful, beautiful powdery sand here and the beautiful crystal clear waters, it rivals the Bahamas, to be honest. Like, if Canada, maybe someday it will become a tropical oasis. They're saying that the weather in Ontario here is going to eventually become tropical, with the way things are shifting and changing in the next, 100 years or something. So a couple hundred years. So we may not even have a winter here someday, but for now, I think the summer, if money was not a non-object, and like it shouldn't be when you make your decisions, I think in some ways money shouldn't matter. But if you look at it from that lens, and of course money matters, but you look at it from the lens, in the summer, I want to be nowhere else but visiting and traveling through Ontario. There are parts of BC that are also very, very beautiful in the summer. But there's no other place I'd rather travel than Canada in like July and August. Let's say at least July and August. Just a beautiful place. And then the winter, like Canada gets really shitty. It's great for skiing for a week or two, but then it gets really crappy. And you want to be somewhere warm. And so the ideal life for me is a bit nomadic in the sense that like I want to live in more than one place because I want the best of both places at different times. And like hurricane season is horrible in Florida and in the Bahamas. And the hurricane season tends to be like what? I think it's like July to like October, November-ish. Sort of no longer a risk after November, let's say. But like that period, Canada's not so bad then, right? So there are places you can go in the world that are better during different times. Bum, bum, bum. Stock investing is good because it has an unlimited scale. You can scale it, like the scaling of it is very easy. But the problem is it's too hard to beat the market, so don't even try. Very, very true. That's a great comment. I wish I could pin that one. It's a good one. What are some tactics you use when negotiating with contractors on price? How many quotes? So tactics, I don't know. Like part of it is just understanding how to do the job. So when you show them that you have the knowledge and their knowledge is nothing, they're just providing the labor to do the thing. It often is much cheaper. So I would show them that I know exactly how to run that. So I would say, hey, I would take the circuit here in 14-2 wire and I would staple every so often and I put my plugs here, here, here. When I map that for them, electrician's like, whoa, you know what you're talking about. Like you've run wire before. And when you can see how they see, that gives you an edge. The other thing is just like multiple quotes. Say, hey, like I just got a quote for 2,000. Do you think you could do it? And if you just ask, a lot of times like they'll take their quote down from 2,500, cut their profit down 2,000 just to get the job. Especially if they've been to site already, made a quote, they're emotionally invested. There's some sunk cost for them. They want to get the job. And so you can always negotiate a little bit. There are lots of techniques you can use, but oftentimes multiple quotes is super important to make sure you're not getting taken advantage of. You need to make sure that you can compare against other contractors. A lot of contractors like to charge whatever they want to charge. It doesn't work that way. It's a competitive marketplace. There are 5 guys that will do your drywall. There are 5 guys that will do your plumbing. There's probably 100 guys who will do that job for you. So they're a commodity. They don't have anything special, and that's the point. As the general contractor running your flips, you need to realize that trades are indispensable. You have to think that way. Now, at the same time, I'm saying that, but there are some guys who are really, really awesome that you want to keep on your team. I have guys that have worked with me for 5-6 years. I keep using them. They're amazing, right? So there's some people you want to keep using and you focus on their strengths. Everyone has their cons, but you focus on their strengths, not their weaknesses. And I sometimes won't grind on price with a guy that I really like, who I know works with me well, who I know won't take advantage of me. I might pay a little more than I'd pay someone else to do the job. But in the end, I get a better quality product and it's done fast and it's done right and we have a good working relationship. So sometimes you don't need to negotiate. But if you're just getting started in this business, you need to get 5 quotes for everything. And you can tell right away. I can just tell right away the expensive guys versus the cheap guys. And I always want to go with the more mid-class, mid-grade kind of guy than the more expensive guy. The guy who shows up with a really fancy truck, who's got like 2 assistants and this and that. Their work isn't necessarily much better, but they're going to bill you $100 an hour instead of the guy that's $50 an hour, who shows up in a maybe more of a beat up truck that's kind of a rough around the edges. Obviously, he doesn't have an assistant to take his calls. You just call him on his cell phone and it's just him answering it. That smaller operation is way cheaper because their overhead isn't huge. They don't have like company trucks and all these expenses. You just pay for all of that. And like, do you care if they show up in a fancy truck, if they get the job done? Do you care if they have 3 assistants doing all their paperwork, or if they invoice you 3 weeks later because they're doing it, their wife's doing it? I'd rather have that guy who's got his wife doing it. He does better work. He's focused on his work as opposed to like marketing and whatever, building systems. For the most part, that's been my experience with finding good deals on contractors that do decent work. Now, if I was a contractor, I'd want to be the guy that's scaling with the big staff that's charging a lot of money. But as the person who's paying for that product, I'm not a homeowner who wants a really nice customer service experience. I just want someone to do the job that I have planned for them. And so I often need the guy who's neck down, not the guy who's neck up. So I don't need the salesy contractor. I need the guy who knows how to get the shit done, who doesn't know how to sell, but knows how to do. That's just what you're looking for in this type of business versus like Nancy and John who want their bathroom remodeled for $45,000. I can do a bathroom for $5,000 paying guys hourly. It's like there's such a markup with the mom and pop, and you don't want to use those companies that are luxury. You want to use the guys a little rougher around the edges. He might even threaten you. That's part of it. That's part of knowing you got a good contractor. A little rough around the edges. What are some tactics? So we had that question. John says, what are some quick calculations you do in your head? Tell that a property is a great deal or buy it. It depends on the market, but like, so quick back of the envelope math is usually like the 1% rule, something I would use. So I would walk in a property and say, okay, what can I rent this out for? I'd add up if it's a duplex or 5-plex, I'd add up the rents and say, okay, can this property generate me a net rent, a passive rent of 1% of the purchase price every month. So if it's a $500,000 property, can it bring in $5,000 a month to cover my expenses? It used to be a 2% rule before markets got inflated and drove prices to insane levels. I used to be able to go into a property and say, when I'm done this renovation, this should be able to bring in 2% of the property value every single month in rent. Now it's a gross number, not a net, but you're getting 2% back in rental income. Not net, but gross. So 2% a month was the goal I used to go for back in the day. I'd go $500,000 property, I want $10,000 a month in rent. That you could find those. 1 in 10 properties met that metric. 9 out of 10 properties didn't. So most landlords I met were idiots and bought shitty properties that didn't make those metrics. And so not all landlords are the same. Not all real estate investors are the same. There are unicorn investors and there are less unicorn investors. You want to be the unicorn. That means typically buying really quality stuff that is in a shittier area, having to fix it up. Sometimes the quality isn't to the same level as the new build house. You're going to have that shitty house that's drafty and has problems. That comes with all the cash flow, right? You're going to have problems with it. A lot of investors want easy, and easy does not pay well. So you got to pick your poison, pick what you want to deal with, pick your hard. But yeah, real estate's I love real estate. I think it's a great asset class, and it really does have some distinct benefits when comparing to other asset classes. As an example, non-callable debt is pretty nice. And it's also really passive. Like most businesses, you buy a business, you have some good staff. If you lose key staff, you're fucked. With real estate, you can rip and replace. You lose a key manager, there's 2 more managers you can plug and play. It's so simple that like a contractor, you lose your key contractor, no big deal. Plug in a new contractor, plug and play. Real estate's so easy to make passive. It's a business that I think is easier than, say, if I bought machine shop business that sold widgets, just making something up. But that specific widget, those staff know how to make that. It'd be hard to train new people. Your accounting staff, it's difficult to replace that. Your COO, your lead guy who runs everything, your chief of operations, you lose him, it's hard to find a replacement. So it's a more difficult business. If you lose those key staff, your business becomes worthless. But in real estate, you lose a key property manager, the building doesn't really lose that much in value. That's what I like about real estate, is the safety of it. If you buy right and you're buying cash flowing real estate, there's a lot of safety in that. The max loss is defined unless you're an idiot. I have seen some idiots run properties. I seen someone buy a property once and did the stupidest renovations I've ever seen. More recently, I saw someone convert a 4-plex into a duplex. What are you doing? They're like, oh, I'm taking away units because it's better as a bigger unit. What? Your rent just went in half. Your cap rate is shit now. Your building just went down in half. What was the logic here? And you spent 6 figures to do that. Some people just make bad decisions. And if you make if you're stupid about it, you can lose money in real estate. If you were to take a 5-bedroom house and turn it into, and I've seen someone do this before, take a 5-bedroom house and turn it into a 1-bedroom house. It's what? They're oh, I wanted an open concept. Looks amazing. I saw on HGTV that open concept is the way. And what? And then they're yeah, what? I had 2 units, but I made it into 1, and it's way nicer now, and I want to live in it. But I changed my mind. Now I'm not going to live in it anymore. But I'm putting it for sale. And it's what? You spent $50,000 to drop the value of $100,000 in this property? And I see this all the time. My mom, as an example, I don't know if I'm under the bus, but she's the perfect example of someone who's a typical homeowner who will do a funky design. They'll pick the weirdest tile. They'll try to preserve some old window. They'll put they'll try to preserve something in a house, and they'll spend tens of thousands of dollars on this thing that has no value to resale. When you look at a flip, how you make a good flip versus a bad flip is how you spend your money. So as an example, if you fix something in the wall that no one sees, it adds no value. If you were to open the floors up and sister a joist, you're now in your head it's super strong, it's great, but the buyer doesn't see that. They don't feel that. They don't notice. In most cases, you get nothing. You spend $10,000 doing that, you lose the $10,000 that's gone. If you put in a $10,000 furnace or a $3,000 furnace, both are new furnaces. From a resale perspective, there's no difference. From an appraisal perspective, there's no difference. People clean their ducts out and they do weird stuff. I'm what are you doing? They're oh, I put brand new eaves troughs. The old eaves troughs were fine. It didn't impact value negatively. They weren't falling off. They were okay. You could have painted them, as an example. There's the kitchen. People rip out the whole kitchen, put a whole brand new kitchen. I'm the kitchen that was here was 2005. The cabinets were decent. You could have painted them. And your resale value is the same. You compare the comparable analysis of the neighborhood expects that kind of kitchen, and you went above and beyond. There's no extra value for that. So in a lot of cases, you don't get anything extra for going above and beyond. If you renovate a $300,000 house like it's an $800,000 house, and you put in those kind of finishes, you get nothing back. You put a $10,000 fridge in versus a $1,000 fridge that you bought used that looks just as good, stainless and nice. That $1,000, $2 fridge that you got used will sell in that house. The house will sell for the same price as you bought an $8,000 fridge that's top of the line. No one gives a shit. You're going to lose the $7,000 difference you spent. And so that's where I see people in real estate make mistakes, is they're idiots. And they do things that they like. And it doesn't matter what you like. Look at the comparables in the neighborhood, what has sold, the actual sales. Look at what those properties look like. Make your property look just like those properties. If they have shitty vinyl plank floors, you put in shitty vinyl plank floors. If the neighborhood has really nice hardwood floors, you have to put in really nice hardwood floors. That might be something you have to do in that neighborhood. But you got to look at what the buyer is doing. And if the buyer of your house is an average $300,000 house in Ontario, that's like your customer that's going to buy that house off you in the future. Even if you're living in your house for yourself, think about selling that house. How are you going to, what if something happens, you have to sell the house? What if you change your mind, you find your dream house, you buy something else? I always think whenever I do anything, what will this look like to a buyer? It's the only thing that matters in most of my decisions. Even when I have my own personal house, I'm thinking about the buyer, the end customer all the time, and I'm designing everything for them. What does that end customer want? And I'm thinking about, is there an ROI on that? And that may sound a little weird that I'm always thinking in terms of ROI, but that's just how my brain works. It's just, that's what you should be working in real estate. So if you're not that kind of person, you need to become that kind of person, or don't touch real estate, because you can screw it up. And I see it happen a lot. But if you do it properly and you don't make critical error mistakes like over renovating or under renovating or taking away units or bedrooms, like what? I don't know why people do that. There's just so many critical errors I've seen people make in renovations. It's wild. Don't do that stuff. The negative value on people converting properties. I've seen some crazy things over time. I've seen people paint walls crazy colors. I've seen people put in the weirdest floor. And like as a realtor, you bring someone through and the first thing the buyer wants to do is rip all that out. So they're saying, what is it going to cost for me to redo all these floors how I want them? Well, now they're going to undo everything you just did, and you're going to lose all this, whatever you spent to do that. So it comes off your purchase price. And it's something you got to think about in real estate, and it's obviously a challenge. Okay. In the beginning, when you did property management for yourself, for your units, did you set up a property management company for yourself and invoiced your own company? No, I didn't. I just did it myself. I didn't invoice myself. The only reason you'd ever, there's no reason to do that. I see people make that post, and I'm like, all the guys who talk about making their own management company are idiots. Because at the end of the day, when you think about it, it's like, why in the hell would you ever invoice yourself and charge yourself HST? There's a 13% HST on any invoice over $30,000 a year. So if you had a larger property management company, you now have to create 13% tax you pay to the government. Why would you do that? Why would you create sales tax for yourself? So in Ontario, it does not make sense to do it. Stock investing is good because in the limited upset. I gotta go. My daughter's screaming here. I gotta let her go and put her to bed. I'm not gonna be able to get through all these questions, I don't think. I'm sorry, guys. She's losing her mind up there. I think she's tired. She wants Daddy to put her to bed. I'll pick like one more question. Do you have any programs? No, I don't. I don't. The Tasty Trade offers free options trading courses that are fantastic. So go check out Tasty Trade. It's free. But again, I don't believe you should be trading. I think in general, you should buy many different asset classes or find the thing you're good at and invest just in that, and then spread some of those profits out into the S&P 500 or other various asset classes. But trading in general, I think, is not a good idea. In general, it's very hard to beat. Most retail traders cannot win. They cannot beat the market over the long term. Which Ontario real estate market would be good? It's hard to say, right? I think they're all going to have the same general direction this spring, which is up as rates fall. But I would say markets that are higher price point would do better with rates falling. If you lived and worked in Toronto, wouldn't you buy a house and house hack? No, I wouldn't. For emotional reasons, I might, but I physically, I think probably better to rent and invest the difference. I think it actually wins out renting and investing the difference. At what number of cash flow per month did you decide to quit your T4 job? How do you arrive at that number? For me, it was 25 times annual expenses. So what I needed to spend to support everything, I need to have 25 years of a runway. And I can invest that and collect a 4% take 4% out of that portfolio and use that to live on. And I was sure that I was okay. With real estate, if you're going to spend a little bit of time managing your rental properties a little bit, I think an 8% draw rate from your portfolio is reasonable. So that's about 12 and a half years of living expenses. So if you spend 50 grand a year at that rate, you would need like $750,000 at least and then go buy properties and lever that up. If you're not going to do that, you need about $1.5 million, I would say, at that spend rate. So it depends on your spend rate, right? It's all about what you spend. So if you find ways to live on less, that's huge, right? With house hacking, you can bring expenses down. Toronto just doesn't make sense to house hack. I gotta try to pick another question. Looking at private equity. How would you find money partners? Yeah, I mean, there's definitely ways to do that. You can totally use a GPLP structure. I've done lots of JVing and stuff like that. It definitely is doable. Finding partners comes down to like, there are lots of ways to do it, but one of the ways is like social credibility and influence and sharing your journey and what you're doing. You need to have experience. So if you're just looking to leave private equity and you've never done real estate deals before, you need to partner with someone who has the experience in construction, who understands property management, who's done deals before. Bring them on as the expert, and you can maybe be the capital raiser that works with them to help raise capital. Maybe there's something there, maybe we should chat. If you're good at doing that, you want to put pitch decks together and do presentations and help raise capital, I can happily tee up something with you and share a percentage of deals. 2024 is not the year for me to explode that, but 2025, I'm going to really go hard on doing some really big deals. It'd be fun. So reach out, rosehartcapital@gmail.com. Do you buy new appliances? No, I don't. I go used. I go new, used. Never new. New, you don't get the ROI. You get something that looks like it's new, but it's not. And you get it for like half. I can get a washer dryer set for it's stainless steel, looks amazing, for $250 for a washer, $250 for a dryer, $100 for delivery, $600. I have that in there. I go to Best Buy, I go to like, one of the appliance stores. I'm gonna pay like $1,800, $2,000 for that stackable set. What a ripoff. Why would you pay $1,800 when you can pay $600 and get it done? And it looks the same. And the buyer pays the same amount of money for it. So that's $1,300 of profit. Every decision you make needs to generate you an ROI. Most people don't think in terms of like, is this purchase going to give me ROI? They're like, oh, a buyer would definitely pay more for that. It's like, buyer will not pay more for a $8,000 furnace versus $2,000 furnace, or a $3,000 fridge versus a $500 fridge. If they look the same, it doesn't matter. If you're gonna sell it in a year, used is just fine, perfectly fine. All right, everyone, have a great day. And remember, the secret to unlocking wealth through you is 3 levers and control your financial future: spend less, earn more, and maximize returns in the difference. See you guys next.